Imagine a single strategy that threatens to wipe out $800 billion in Chinese value, disrupt global markets, isolate China from half the world, and all of it coming not from missiles or spies, but from spreadsheets, tariffs, and backroom diplomacy. This isn't fiction. This is happening now. The United States, under President Trump's renewed leadership, has just turned the global trade system into a geopolitical weapon. But here's the twist. The fallout isn't just numbers on a screen. It's pressure campaigns, satellite accusations, and AI warfare with CEOs on damage control missions in Beijing. So what is the real goal of this campaign? Why now? And who's really getting hurt? In this video, let's find out. It didn't start with bombs, but with tariffs. In a return to aggressive trade diplomacy, Donald Trump's administration has reignited its mission to not just outcompete China, but to surround and suffocate it. At the center of this bold strategy lies a simple but ruthless formula. Offer tariff exemptions to America's allies in exchange for one condition: isolate Beijing. Unveiled during a closed-door meeting at Mar-a-Lago on April 6th, the strategy is a geopolitical move disguised as economic policy. The U.S. aims to make China toxic in the global supply chain by targeting its backdoor routes, nations like Vietnam, Malaysia, and Cambodia that have historically helped Chinese goods circumvent restrictions. Under the new plan, these nations are being pressured to cut those ties or risk their own access to the lucrative American market. Europe, too, has been dragged into this trade realignment. While Trump's team has offered a short-term reduction in tariffs from 20% to 10%, the catch is obvious. That relief hinges on European compliance. Countries like Spain are being warned bluntly: side with China, and you will bleed. This isn't just a trade battle. It's a psychological siege. The goal is to create the impression, and then the reality, that China is alone. And Beijing has noticed. From Beijing's point of view, the shift is unmistakable. This isn't business as usual. This is encirclement, strategic, economic, and ideological. As America ramps up pressure, China finds itself scrambling to plug the leaks. President Xi Jinping has embarked on an emergency diplomatic offensive, visiting Southeast Asian nations like Cambodia, Vietnam, and Malaysia, countries long considered logistical lifelines for China's exports. If these nations bow to U.S. pressure, China's manufacturing web begins to collapse from within. Interestingly, this siege isn't contained to Asia. It's transcontinental. In North America, Mexico is being leaned on to impose tougher restrictions on Chinese electric vehicles, part of a broader campaign to deny China access to emerging industries. Across the Atlantic, European powers are being torn in two. Washington's ultimatum is clear: stand with us or lose preferential access. But China's economic gravity still looms large, making the decision anything but simple. Caught in this tightening vice, China is forced to reassess its global positioning. For years, it relied on economic leverage. Now that leverage is under assault. But the real blow, the one that sends chills through Beijing, isn't just diplomatic isolation. It's financial warfare. While trade negotiators posture in front of cameras and leaders exchange smiles behind closed doors, something far more serious is festering in the undercurrents of the global economy. And this week, Goldman Sachs delivered a devastating forecast that shattered any illusion of normalcy. The firm issued a chilling warning. A full-scale financial decoupling between the United States and China could be imminent. And if it is, the cost won't be measured in tariffs or policy points. It will be measured in billions of dollars, hemorrhaging from some of the world's most tightly woven financial arteries. According to Goldman Sachs, the fallout from such a rupture would be catastrophic. In their latest model, the U.S. could be forced to unwind as much as $800 billion in Chinese assets. That staggering figure includes $250 billion in American depository receipts, essentially the backbone of Chinese firms listed on U.S. exchanges, and an estimated $525 billion in Hong Kong-listed shares held by U.S. institutions. Beyond that, the exposure stretches into China's onshore equity markets, where American investors maintain positions that, while smaller in size, are tightly interlaced with broader fund strategies. This scenario is not an abstract worst-case thought experiment. It is a real escalating risk, catalyzed by Washington's increasingly hawkish rhetoric. Treasury Secretary Scott Bessent's recent statement that all options are on the table has triggered fears that forced delistings, asset freezes, and retaliatory financial firewalls are not just possible. They are being considered. The numbers are terrifying, but so is the timeline. Goldman projects that even under orderly market conditions, a fantasy during geopolitical crises, it would take 119 days for U.S. investors to offload their Hong Kong positions, and 97 days for American depository receipts. In a world where stock prices can crater in minutes and flash crashes wipe out fortunes in seconds, that delay is fatal. The bloodletting would be slow, painful, and visible to every market algorithm and hedge fund short seller on the planet. And yet, the story doesn't end there. Because in this economic game of mutually assured destruction, China has its own nuclear options. Before we continue further, tell us, are you enjoying the video? If yes, please like and share the video and subscribe to our channel. To watch more videos on the latest news stories on geopolitics, economics, and current affairs impacting your lives. Goldman's report warns that Beijing could retaliate by dumping up to $1.7 trillion in U.S. financial holdings, including $1.3 trillion in treasury bonds and another $370 billion in equities. Such a move wouldn't just jolt markets. It would send the U.S. debt machine into cardiac arrest, spiking borrowing costs, hammering the dollar, and placing America's fiscal credibility under siege. This kind of financial decapitation would mark the true beginning of an economic Cold War, not just trade friction, but the collapse of decades of globalization and mutual investment. The fallout would stretch far beyond Wall Street and the Shanghai Stock Exchange. Pension funds, ETFs, tech sector valuations, and even mortgage rates could feel the shockwaves. The modern world economy, interconnected, codependent, and increasingly fragile, is not designed to withstand the sudden unwinding of its two largest pillars. It's easy to think of markets as abstract, as green and red lines on a chart, but behind those numbers are jobs, retirements, infrastructure projects, and national budgets. A collapse of this scale would not remain confined to financial spreadsheets. It would ripple through global supply chains, investment confidence, and consumer behavior from São Paulo to Singapore. This is where the so-called encirclement strategy takes on a darker tone. Because if the economic blockade intensifies and capital begins to flee in both directions, we may no longer be watching a trade war. We may be witnessing the construction of economic walls so high that they will divide the world for generations. It's being reported that extreme U.S.-China decoupling could result in a $2.5 trillion loss. And if this comes to pass, no one will escape unscathed. Now, as financial markets brace for a potential $800 billion shock, the battleground is expanding, literally, into orbit. Just as Goldman Sachs warned of the economic costs of decoupling, the U.S. launched a new front in its pressure campaign: the space tech domain, and China once again is the target. This week, U.S. officials accused Chinese satellite firm Changguang Satellite Technology of providing surveillance imagery to Houthi militants in Yemen, allegedly helping them strike U.S. Navy vessels in the Red Sea. Though CGSTL markets itself as a commercial company, Washington insists it's a cog in China's military-civil fusion machine, a strategy that fuses private sector tech with military objectives. This isn't just a moral outrage, It's a calculated move. By publicly linking Chinese commercial satellites to attacks, the U.S. is laying the groundwork for a broader sanctions regime, not only against CGSTL but against any firm blurring the civilian-military line. This could unravel large chunks of China's global tech ambitions, and it signals that the war over trade and investment has evolved into a war over control of strategic intelligence. Beijing has denied the allegations, but denial may not be enough, because this is about perception, and in geopolitics, perception often beats facts. And as that narrative hardens, another front quietly opens. While accusations fly over satellites, the tech world's most powerful company is trying to hold the line with trembling hands. NVIDIA, the global leader in AI chips, has found itself stuck between two geopolitical earthquakes. After Washington banned exports of its cutting-edge H20 AI chips to China, NVIDIA's CEO Jensen Huang boarded a plane to Beijing. It wasn't a courtesy visit. It was a firefight disguised as diplomacy. Huang's meetings with senior Chinese officials and DeepSeek, a Chinese AI startup accused by the U.S. of links to the People's Liberation Army and nuclear weapons programs, sparked outrage in Washington. But for NVIDIA, the calculus is existential. Nearly 20% of its revenue is tied to Chinese markets. Losing that would decimate the company's valuation, upset investors, and gift a golden opportunity to Chinese competitors like Huawei. Publicly, Huang struck a delicate tone. He emphasized that China remains a very important market. Privately, NVIDIA has argued the export bans are ineffective, that China is rapidly catching up, and that bans only slow U.S. firms while pushing Chinese innovation underground. But Washington isn't convinced. In fact, Huang's trip might be NVIDIA's final warning. One misstep, and the company could find itself in the same position as TikTok or Huawei, subject to bans, forced divestments, or political death by 1,000 subpoenas. The stakes could not be higher, because AI is no longer just a technology, it's a weapon. And those who control the chips control the future. Now, what started as a battle over soybeans and tariffs has mutated into something far more sinister, something wider, deeper, and harder to contain. It is no longer a trade war. It is a systemic rupture. Across financial systems, investment markets, supply chains, digital infrastructure, satellite networks, and artificial intelligence, the United States and China are now entangled in a confrontation that bears all the hallmarks of a Cold War, minus the subtlety. Trump's encirclement strategy is no longer theoretical, it's in motion. He is isolating China with military alliances, economic pacts, satellite surveillance, and financial restrictions. The goal is not merely to compete, it's to break China's rise by cutting off the arteries through which its power flows. China, in turn, is fighting back with strategic alliances, Belt and Road diplomacy, and aggressive technological self-reliance. Xi Jinping's visits to Southeast Asia are more than photo ops. They are firewall-building tours, aimed at halting America's pressure wave from sweeping the region. And caught in the middle are companies like NVIDIA, banks like J.P. Morgan, and investors sitting on $800 billion worth of Chinese exposure, unsure whether tomorrow brings profit or liquidation. What do you think? If $800 billion in Chinese assets can be threatened overnight, what happens when the U.S. starts targeting foreign banks holding China's debt? Do you feel the U.S. is building an alliance or coercing one? In the comment section below, share your thoughts on who you think will win the trade war between the U.S. and China. Do you want to watch more videos like this one? If yes, subscribe to our channel and press the bell icon next to it. We bring the latest news stories on geopolitics, economics, changing world order, and current affairs. Things you need to stay informed. Thanks for watching, and until the next video, stay tuned.